Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the conventional fund business initially. We'll talk about exchange traded funds later on as well. For the week ended Wednesday, January 17, 2018. You might be a little surprised to find out that we actually, on a conventional fund business basis, saw about $17.1 billion flow out of the conventional fund business. And actually, the headline numbers are quite misleading. Most of that is money market withdrawals actually happening. Actually, we had a very good week this week as far as the market goes. People are still pretty exuberant over tax cut, hearing good news about outperformance by third quarter earning report by most firms, and that's what they're anticipating. So really, they bid up the markets quite well. In fact, the Dow finished the week up 2.94%. That is a 1 week return for the second fund flows week, again ending Wednesday. So really some pretty good numbers. Let's see how those numbers panned out to flows to the macro classifications. If we take a look at equity funds, we saw about $100 million join those assets in the equity universe. And then we take a look at the taxable bond funds. They had about $3.3 billion to the conventional fund business. And muni bond funds also saw inflows about $1.1 billion. It's a big number. Second week in a row, we've had over $1 billion in inflows, so that's quite a story there. But again, the big storyline was the outflows of money market funds. Not that big. In a year that's pretty normal to see money out of money market funds, corporate treasurers, putting money to work back in our 401ks, etc. So we saw, again, about $22.3 billion in outflows. Again, not a big story. That's normally what happens. It's called short-term funds for that reason, and why long-term assets are considered, the equities and the bond funds. So that's really not too alarming. Let's take a look at how it panned out, though, for the equity universe on the conventional fund side again. If we take a look at it, we saw about a 1.89% return for the average mutual fund. That was really good. It's been up for 4 consecutive weeks in a row as far as returns go. And for the 4th consecutive week also, we saw net new money come into the coffers, this time to the tune of about $845 million. And how it broke out is just what's been happening over the last several months, maybe even over the last couple of years. When we take a look at it, domestic equity funds took it on the chin, saw about $2.6 billion leave their coffers. And it's the 3rd consecutive week they've seen outflows. But if we take a look at the non-domestic equity funds, we see that they took in about $3.5 billion, 4th consecutive week. Now, if we take a look back, domestic equity funds had a 1.88% return, while the international or world equity, let's call it non-domestic equity funds, had a 1.92%. So this isn't performance chasing. This really is just, if you will, a preference or a reallocation from the domestic to the non-domestic side of the universe. As we take a closer look and dig down a little bit deeper, we see that the large cap funds lost about $1.4 billion. But again, as I was saying, international equity funds saw about $3.8 billion, and Japanese and emerging markets made up together about $1 billion of those dollars that came into those coffers. Again, this is just a combined universe when we're talking about domestic and non-domestic. Let's go ahead and take a look at the ETF universe to see what happened in that arena. For the 2nd consecutive week, they saw inflows, about $8.2 billion. The big winner this week was SPY, Spider S&P 500, basically taking about $4.8 billion. And then the next group was the iShares Core MSCI EFA, took in about 919. If we look at the very bottom, we see the iShares Russell 1000 Value Index losing about $1.9 billion, followed by the Wisdom Tree Japan Hedged Equity Fund losing about $645 million. Not a lot to write home about there, but certainly we saw that the authorized participants, those people who invest into and create and destroy, I should say, shares for ETFs, they certainly were still keeping the pedal to the metal. Let's go ahead now and take a look at the fixed income universe to see what happened in that group. Fixed income funds for the 3rd consecutive week saw inflows, this time to the tune of about $3.3 billion. 4th consecutive week, they've seen plus side returns, though this time they saw about a 0.45% return. Kind of a head scratcher considering there was just a scare in the market that the Chinese government were going to stop buying treasuries, and that put the yield curve on a little bit of a tilt upward. Basically, we saw the 10-year gain about 5 basis points during the week. So again, pretty good returns considering the treasury yield curve actually went up a wee bit. The big winners here, when we take a look at it, corporate investment grade debt funds took about $3.8 billion. 33rd consecutive week they've taken in money. And we also saw international and global debt funds taking about $210 million. And at the very bottom of the barrel, we saw corporate high yield lose about $1.1 billion. Now, that's kind of a head scratcher, right? Equities did well, really fixed incomes did well. Why high yield? Our hypothesis is investors see interest rates rising and they say, hey, listen, that spread is no longer big enough for us to want to engage in high yields. And so we saw high yield redemptions until those spreads widen a little bit more and compensate for the greater risk you're doing with high yield. Let's go ahead now and take a look at the fixed income universe for ETFs. Basically, they saw about $826 million in outflows. That's where first week and forward they've seen outflows. ProShares short VIX short-term futures saw about $400 million net new money coming to that group. And then the iShares JPM US Dollar Emerging Market Bond Fund took in about 371. At the bottom of the barrel, we saw the Spider Bloomberg Barclay High Yield Bond Fund lose about $1.3 billion. Kind of the same tune we were just talking about. So people not necessarily souring on high yield, but they certainly, if they're going to be out in high yield, take that risk. They might as well just go for equities, right? Because considering that we have more interest rate increases on the horizon, or if not, at least get greater spreads. Let's go ahead now and take a look at muni bond funds to see what happened in that group. Basically, we saw about $1.1 billion. Second consecutive week, as I said before, that they've taken in net new money. And not only the second consecutive week, but it's the second consecutive week they've been over $1 billion in numbers. And when we take a look at it, it's the third week in four that they have a plus side return, this time to the tune of only 0.07%. And we see that actually one American fund's tax-exempt bond fund was accounted for about half of those inflows. And we've actually have been doing some check-in and contacting the fund firm to make sure that, in fact, those numbers are good. They look solid right now for us, so we're going to continue on with that number. National munis, because of that one particular inflow, so about $1 billion of those net inflows come into that particular area. Let's go ahead now and take a look at money market funds. And money market funds, as I told you before, third consecutive week we've seen outflows. Very common when you come to the beginning of the year-end touring of the books and corporate treasurers paying out for the year 401ks and that kind of stuff. So certainly we see big moves in money market funds at the beginning of the year. Very, very common. Taxable money market funds. So about $23.6 billion in outflows, and how that broken out is basically institutional funds. So about $16.4 billion in outflow, while retail funds saw about $7.2 billion in outflow. Now, that means on the tax-exempt money market side, we saw inflows, which we did, about $1.3 billion. Well, that's it for us today as far as flows goes, but we do have some interesting stalemate coming ahead, and we'll have to see how that impacts the market going forward. We've certainly seen this happen before, a government shutdown. Everybody's saying it's too late to make any deals on Friday. Today is supposed to be when it goes into effect over the weekend, and we'll just have to see if that impacts investors or if they're pretty sure that earnings season is going to actually kind of swamp that, and of course, sooner or later the government is going to have to go ahead and fund their projects. So we'll have to see how that certainly shapes out. If I didn't do a deep enough dive for you this week on fund flows, you can go to our site, www.lipperusfundflows.com, or join us next week when one of our analysts will talk about the trends and flows for the week. Thanks for joining me, and I'm Tom Roseen, wishing you the best in your wealth planning and creation.